This is week 3 of financial markets. Today I'm sitting in Connecticut Hall, which is the oldest building on Yale's campus, built in 1753, once housed Eli Whitney, the inventor of mass production, some people say, and Noah Webster, the author of the Webster's Dictionary, when they were students here. And this is where the faculty meetings occur at Yale. So what I want to talk about this week is stocks and bonds. And these are the two main categories, traditional main categories of financial investments. So you could also say I want to talk about return as, for the case of bonds, interest or coupon, and for the case of stocks, dividends. What's the difference? It's not as clear as most people would think. And what I want to do in this course is get down to fundamentals. Most people, I think, who are not investment professionals have a little trouble with the essence of these things. We have to be very careful to avoid what John Locke called, the philosopher John Locke called, taking words for things. People think of stocks as whatever is called a stock is all the same thing, but it's not true. Many different stocks look very different. As we'll see in this week's lectures, suppose a company decides to issue a lot more shares, and with the proceeds of the shares, invest in bonds. Okay, well, if they do that really aggressively, what are you owning when you buy the stock? Well, the original business was diluted down to possibly, if the share issuance is aggressive enough, to negligible proportions. That's dilution. At the same time, the stock is now really represented by the bonds the company owns. So the stock becomes almost a bond. Or in reverse, a company can do the opposite of that. They can borrow money and buy back shares, and then that's the opposite of dilution. Then the company becomes leveraged, and then it becomes riskier than most stocks because it's kind of an amplified stock. We already alluded to that kind of process before in our lecture on the capital asset pricing model. But I want to get in this time really into more of understanding what a corporation is and what it does. What is the essence? What is this thing called stocks? Some people think, well, stocks are investments that people buy so that their price can go up. Well, that's a naive view of what stocks are. They are an essential element of a modern capitalist economy for the functions they fulfill. Another thing is interest, and compound interest, for example. That, I think, is also poorly understood. Maybe one understands it at some technical level, but doesn't understand how to apply the concepts generally. So suppose I have $10,000 to invest, and I have two alternatives. One, I can invest it at 5%, and another one is at 7%. Does it make much difference? Well, if I'm investing for 1 year, well, it makes $10,000. There's a 2 percentage point difference. That's, $200. So it's about what I could buy a nice dinner with. But what if I'm investing for 40 years? Say I'm investing for my retirement 40 years in the future. In that case, the difference between the two, if you work it out, assuming quarterly compounding for the whole 40 years, the difference is $87,000. It's huge. That's almost like a small house. So the power of compound interest is something that you have to appreciate and understand. It's one of many principles from finance that are important to grasp. This week, we also have Laura Cha from Hong Kong, who is on the board of directors of HSBC, the bank, was on the executive council of Hong Kong, and also was on the China Securities Regulatory Commission in mainland China. So a very distinguished woman in finance who we managed to link up to all the way to Hong Kong by electronically, so our class could see her telling her story. And it's an interesting story that she tells. It's a story about the development of Hong Kong as a financial center. When she started out and became a regulator in Hong Kong, the Hong Kong stock market was a local market that no one outside of the immediate area took very seriously. But with the help of good regulation, it won the trust of the entire world and is now a major international financial center. And it's a major center for the trading of mainland Chinese shares. So, how did that happen? I think that, again, we have to avoid taking words for things. We tend to think of a stock as some kind of certificate, and it just somehow goes up in price. It's people that it represents. It's an organization. A stock is a claim on ownership of an organization. And people like Laura Cha are examples of the human force that really lies behind stocks and bonds. Part of what I'm getting in this week is the importance of regulation. Laura Cha talked about her career as a regulator and how she found it very rewarding. Well, I think it was rewarding for her, and it was rewarding for Hong Kong, and it was rewarding for the whole world. We need regulators. Regulators set the rules of the game, and they're public-spirited, and they make changes that matter. Business people to themselves, thankfully, are also self-regulators of a sort. Because of the personal integrity that they feel, and because of their concern for the long-run health of their business, they may sometimes act like regulators. Not always. Well, I give an example in one of the lectures of the Buttonwood Agreement, which was the agreement that created the New York Stock Exchange. Well, I looked at the whole agreement back in the 1790s and couldn't find much idealism there. In fact, what it was a price-fixing agreement. It would be illegal today to do that. But I think the New York Stock Exchange over the years has adopted in a stronger and stronger sense of public trust. By the way, in one of these lectures this week, again, they were recorded in 2011, I mentioned the Deutsche Börse, which is the German stock exchange, as about to or likely to acquire the New York Stock Exchange. Well, that was factual as of then, but I have to say we now know that the European Union blocked their attempt to do that. The New York Stock Exchange, which had already merged with a Dutch company so that it became New York Stock Exchange / Euronext, was then acquired in 2013 by a U.S. company in Atlanta, Georgia, called the Intercontinental Exchange, or ICE. All these buying and selling of assets shows the importance of the interlinkages of ownership in enterprise that's represented by the stock market. So I think having Laura Cha speak to us this week and thinking about the stock markets, which exist on an international level now and which represent ownership claims, is it really, I think, is important for our understanding of how the world is evolving in the 21st century. Many of us have a childlike view that, well, I live in this country and my identity is created by my living in this country. Well, countries are still important, but so are companies. And people develop part of their identity by their membership in companies. And companies increasingly are owned by people all over the world. I think that's the reality today. We are living in a period of financial capitalism, and that fact is very important for the lives of everyone, not just financial professionals. It's something about the organization of our society that goes beyond the traditional government organization. It involves the government because government regulators are central to the functioning of these markets, but it involves people who may go between government and businesses. They may move around and live in different countries. There's something else, which is a financial sector. It is not amoral. It's, although some people may think it is, the morality is driven by people and their culture and their principles. And this is increasingly the basis for our society as it's evolving today.